Money trusted to move an empire turned suddenly into a crowd outside a locked door. Why did the safest house in the city, the so-called banker's bank, go from steady ledgers to a public collapse that toppled scores of other firms? Why did London's moneymen, who traded in paper promises and steam, find themselves begging a central bank for help that would not come? Keep listening. The answer is in the books, the balance sheets, and a single day in May 1866 that rewrote how central banks thought about panic. The place is Lombard Street, the year 1866, and the name is Overend, Gurney and Company. For decades, it had been the plumbing of Britain's money market, discounting bills, moving short-term cash from exporters to manufacturers, and back again. It was large in a way that mattered. One contemporary account said the firm turned over bills equal to nearly half the United Kingdom's national debt each year, a scale that made it more than a broker. It was a node. That magnitude created trust, and trust had value. But trust is fragile when the business changes. The partners, with new ambitions and market temptations, tilted the firm toward long-term railroad investments and speculative loans that did not match the short maturities of their liabilities. In 1865, they reorganized as a joint stock company, selling a flotation that looked like a rescue, but instead spread risk into the public market. That mismatch between what they owed and what they owned was a financial disease that worked in silence until a trigger arrived. What happens when a merchant bank treats long-term railroad debt like short-term liquidity? It borrows short, lends long, and waits for the music to stop. The trigger came in early May. By the 9th, the firm asked the Bank of England for help. The bank, seeing insolvency rather than a temporary liquidity squeeze, declined. On 10 May, 1866, at 3:30 in the afternoon, Overend Gurney suspended payments and stuck a notice on its door. The next day, the city called it Black Friday. The bank rate jumped, 4 rises in 10 days, and peaked at 10% as panic spread through traders and depositors alike. That spike in the cost of money was more than a number. It was the sound of credit snapping. When the doors closed, the crowd was not only the unemployed partner or a frightened clerk. It was shareholders who had trusted glossy prospectuses, provincial merchants who kept cash with a London house, and rival brokers whose collateral values suddenly fell. Within weeks, more than 200 firms, including other banks and merchant houses, failed or were pushed to the brink, their fates tied to the web that Overend's tumble had frayed. The scale made contagion visible. To understand why the refusal to lend mattered, imagine 2 ledgers side by side. On one page, there are bills maturing next week. On the other, there are bonds that will pay back in 30 years. Overend's profit came from the spread between these. But their safety depended on the market's willingness to roll short-term debt into new bills. When confidence evaporated, the market would not roll. The firm's collateral was suddenly no longer considered good by those who mattered. Other banks and the Bank of England. The path from mispriced maturity to a run is short. What looks like profit in calm times becomes insolvency in panic. There are human moments inside that math. Picture a clerk named Thomas, oil lamp catching dust as he adds up a stack of receipts. He keeps one hand on the ledger and one on a small leather purse. He had left Norwich for London because a Gurney letter promised opportunity. He counts and thinks, how many nights will the dividends hold? A messenger arrives with a terse note. Suspend payment. Thomas folds the ledger closed because paper is where livelihoods hide. He walks out into Lombard Street and sees the crowd. Does he think of the flotation that spread the risk? Does he blame one partner or the market itself? We will never know, but this is the face of systemic risk, ordinary people balancing books that hide extraordinary exposures. That question lodges in the throat. Who counts the cost to people like Thomas? The market did something else that mattered. Overend had also tried, in earlier years, to pressure the Bank of England. In 1860, they retaliated when the bank raised rates, a move that showed the bill brokers could be combative. But by 1866, the bank was a different institution, and when asked for a rescue, it judged the firm insolvent, not merely illiquid. That decision turned the private collapse into a public panic and forced the bank to choose between bailing out one giant house or shoring up the plumbing of the city. The choice shaped central banking doctrine for generations. The economists who followed did not see the bank's refusal as simple cruelty. They saw a policy problem. If a central bank rescues every failing firm, it invites reckless behavior. If it allows a failure, it risks contagion. The painful lesson in 1866 fed a new rule of thumb for crisis management: lend against good collateral and charge a penalty rate, popularized later by Walter Bagehot. He wrote that in a panic, the central bank should lend freely, at a high rate, against good securities, a line that would become the reference point for central bankers worldwide. That sentence is not a platitude. It is the echo of a decision made in a few market hours in May. The collapse had theatrical courtroom consequences. Directors were put on trial accused of fraud over the 1865 prospectus, but a jury acquitted them, the judge calling their conduct grave error rather than criminality. The trial left a bitter aftertaste. Shareholders were ruined, but the law did not find malice. The public wanted villains. The record offered mismanagement and misjudgment instead. What is the difference between a mistake that ruins a city and a crime a court can punish? That question would shape regulations for years to come. Here is one striking statistic to keep returning to, because repetition builds scale into memory. Overend's liabilities were commonly reported at about £11 million when it failed. Think of that number against the era's economy, and imagine the shock in the city when that headline appeared. That single figure helps explain why its fall was not private, but systemic. If this part of the story is making you look differently at how money moves, then join us and we will pull a few more threads like this. We should pause and make the historical lesson quick and sharp before we move to modern parallels. First, the collapse of Overend and Gurney was not simply the result of bad investments. It was the product of a mismatch of maturity and an over-reliance on market confidence that could evaporate in a day. Second, the Bank of England's initial refusal to support an insolvent firm forced it to choose a broader market rescue, which in turn shaped Bagehot's future prescription for central banks. Third, the social damage was immediate. Hundreds of firms and many livelihoods were harmed in the months after Black Friday. Those threads weave a clear pattern. Now for a modern mirror. The Panic of 1866 echoes in episodes like 2007-2008 and the run on Northern Rock in 2007, where confidence in short-term funding and the reluctance to commit public money became central debates again. In each case, the same logic reappears. When a large intermediary borrows short and holds long-term, a sudden withdrawal of trust will force painful choices on regulators and central banks. The instruments change. Mortgage-backed securities replace railway bonds. But the fragility is the same. The thread from Lombard Street to modern finance is direct and worrying. We end with 3 simple takeaways to carry from this story. First, scale matters. A firm that is large enough to touch many ledgers can make a private mistake into a public crisis. Second, maturity mismatch is not technical jargon. It is a daily gamble that can explode when markets stop lending. Third, central bank policy is often the story's turning point. The decision to lend or not will echo for decades. Think about Thomas the clerk again, closing his ledger. His ledger is where we store both routine transactions and the seeds of crisis. The lesson is not moralizing, it is practical. Regulation, disclosure, and sensible central bank rules are the mechanisms we use to prevent private mistakes from becoming public calamities. If this changed how you see the ledgers behind headlines, join our community, subscribe, and let us keep tracing the hidden wires that bind money, power, and history. The rest of this story is waiting in the ledgers.